Hey, I hope you're all doing well out there. This is your April market review. So those of you that have not watched these before, my name is Dan Westfall. I'm a certified financial planner. I'm the founder and chief investment officer of Client Focused Financial. So I do these market reviews each month to give my clients the straightforward information about what's going on in the stock market, the economy, and then ultimately how that affects their investments. So I do this through using a lot of different charts just because I feel like charts are a really good visual about being able to soak in some kind of intangible sort of concepts like the stock market and the economy. So I got a number of different charts here for you to kind of talk about where we're at in the markets, talk through kind of what happened in March with markets being really volatile because of the conflict in Iran. So the first chart that I have, just to kind of put things in perspective for you, is a chart of the S&P 500 as of April the 3rd, and showing kind of where we're at, where it's gone to here over the last month. You can see the drop off we've had over the last month over this. In big picture though, if we rewind this really just brings us back to the same price that we're at in September. So I've talked to a number of different clients here over the last couple weeks, and it's interesting to kind of hear where some people are a little bit more concerned or panicky, and other people are, have no idea that the market's even dropped off at all because they see their portfolio and it's barely moved. So the reason for this is because the stock market's barely moved. So while if you're watching the media every day, one of the reasons I put this video together each month is to give you the straightforward information. The media isn't out there to give you the straightforward information. They're out there to sell you advertisements. So, you're watching it and they're talking doom and gloom because there's a war going on, oil prices spiking, you have stock market volatility. But in the big picture, it's not really that volatile. We're down only a few percentage points for the year. I think we're down about 5% or so for the year right now. So it's really hasn't dropped off that much. The big drop from the peak of the market, because we had gone up a few percent, to where we had dropped off to as of about a week ago was 8%, which really isn't a huge top to bottom drop. Warren Buffett was interviewed earlier this week and was asked about if he thought that there was some values that he saw in the market, if there was any opportunities, and he's like, well, the market's dropped off 5 or 6% for the year so far, so it's only 5 or 6% cheaper. It's not really a big value right now. So is it a better time than maybe a month ago to add money? For sure. But have things dropped off dramatically? Not really. So I want to bring up this chart first just to kind of give you a perspective of where we are. We're really not that far from all-time highs. We could have a good April and be right back to all-time highs again. So put it in perspective with where you're at. If you're a longer-term investor, which if you're working with me, you are, we're going to go through these fluctuations. It's just normal. It's a little bit uncomfortable because we haven't had these types of drop-offs. You can see the drop-off back about a year ago when tariffs were announced was actually a lot more dramatic than what we're going through right now. But other than that, we really haven't had a whole lot of drop-offs since really the beginning of or end of 2022. So we've been going for about 3+ years where markets, as you can see, have pretty much gone straight up with little bumps along the way. This is just the most recent bump that we're having. So nothing that I'm overly concerned about overall. Next chart I have just shows a 10-year chart of the S&P 500, putting it in an even bigger perspective, kind of pulling out that gray bar in there is the COVID recession. So we've had a really good run for a long period of time. A few other charts I'll go through here just to kind of talk through some different points. This chart that I came across was in a Wall Street Journal article I was reading. I'm actually gonna I'll put that Wall Street Journal article in the front part of or one of the links of different articles here. So this chart just showed different rates of return for world stocks during war times or big economic shocks. So World War I, you can see the markets were down in total after inflation 30%. World War II, even less of a drop. The Great Depression, the 1929 drop, obviously that was the biggest. That was a 66% drop. You had the 1973, 1974 oil shock, which in those 2 years combined, markets were down 45%, really big drop off. The dot-com bubble, which in the midst of the dot-com bubble, we had the 9/11 recession. So that kind of, was, definitely two things happening all at the same time. And then we had the great financial crisis from '07 to '09. So we're not in that right now. I mean, it's a conflict going on. There's always some sort of risk of geopolitical events, of things happening like that. Big picture is that companies are doing really, really well, which brings me to my next chart, showing the four-week change in 12-month earnings forecasts for S&P technology sector. So they're at their highest level that they've been at in a long period of time, showing this is just the change in the forecast overall. So there's a 10% increase in it, which definitely a really good sign for the tech sector overall. Companies have reported higher and higher earnings and have higher and higher estimates for their future earnings, which have been reported all throughout the month of March. So that's really going to be the bigger driver of stocks moving forward is what are companies actually making. So there's always going to be noise like this that kind of makes markets move one way or the other, but big picture, it's companies making money and profit that move the stock market. So if we fast forward a year from now, I think that we'll be in a really good spot. Some of the areas that have done really, really well, energy just continues moving higher. This past week it had a little bit of a pullback, but then had kind of rebounded. It's still up about close to 15% from when I entered that position back in the beginning of February, cutting the healthcare sector. So that's done well for people within their portfolios. So little changes like that, I'm looking for opportunities to make other changes. The financial sector is one of them that I'm closely watching right now, just because a lot of the financials like Berkshire Hathaway and different banks like JP Morgan, Bank of America had gone down really dramatically, not just because of market volatility over the last month, but also because of the private, there was this scare in private credit markets of these companies that issue a lot of private credit type of investments to regular individuals that may or may not be high net worth individuals, but there's been a lot of people trying to make withdrawals from there, which has been concerning for those types of companies that are invested in that. But the financial sector overall is doing really well, and banks are doing really well, but they kind of gotten pulled down in that. So it's an area that I'm looking at adding more to. We already have it as part of the portfolio, but I'm looking at adding more to it. Getting into just kind of changing gears here, talking a little bit more about different portfolios that are out there. There's a 60-40 portfolio, which for those of you that are more conservative or coming up on retirement, the 60-40 portfolio is like the traditional type of portfolio that you'd be invested in, where you have 60% of your money in stocks, 40% in bonds. And that's the reason that portfolio exists, is because it's called the modern portfolio theory, where that's the ideal amount of risk versus reward. So you're getting the most amount of reward or return for the amount of risk that you're taking. So typically over history, bonds will go up when stocks go down. But what's happened since 2021 is that bonds are going down when stocks are also going down. So it's become a lot more correlated, which is not what you want in a portfolio, is high correlations between different asset classes like that especially. So one of the reasons within portfolios that what I've done for those more conservative investors that I'm working with is using options-based strategies that help mitigate the drop-off of the stock market, while still allowing you to participate to the degree of some degree of the stock market moving higher. So showing you just a few charts I thought were really interesting, just to bring kind of to your attention, looking at the 60-40 portfolio. These are your 4 worst and best inflation-adjusted years of a 60-40 portfolio going back to 1928. So you have the worst, which was 1974. That was when there was high inflation, and then there was also a big stock market crash. 2022 was the last period, which, one of the reasons, for those of you that were more conservatively invested with me in that time frame, you did a little bit better while your portfolio was still down because of the stock portion. Did a little bit better because the options-based strategies in there. And then you have 1937. That's beginning of a recession at that time frame. That was when World War II was kicking off. 1931. That was another time frame when there was a bigger drop off, kind of a second dip in the Great Depression. On the other side of things, you have really good time frames, which 1928. That was the lead up to the stock market crash. In 1929, you had 1995, which was a really good year both for stocks and bonds. 1933, which was the rebound from the 1931 drop, and then the mid 1950s, which good time for stocks, for sure overall. So that was just an interesting chart to kind of put the 60-40 in its extremes in perspective, so that way people can kind of get a good grasp of when you have a little bit more of a conservative portfolio, which what I use the options-based strategies for is to mitigate that risk of the stock market dropping off. So, for those extreme time frames, we can avoid those bigger drops. Not that you're not going to fluctuate down with the market, but you're just not going to fluctuate down as much. So, another chart I had here, just looking at the 60-40 portfolio here again, I think it's the last chart that I have. Shows just $1,000 in the 60-40 portfolio in different time frames. The 1966 through 81, where basically it was flat. Your 1941 through 1957, where it went up again. It basically went through a doubling period. It was up 2.5 times, up to 2,500. But then there's the big time frame, which this is where, for most of you out there that are in that retirement age, you're just trained to think that you should put money in bonds because of what happened from 1982 through 2021 in that 40-year time frame, where stocks went up and bonds went up, and they helped with kind of alleviating some of the fluctuations along the way. The problem now is that the correlation to stocks and bonds is so close that if you're in retirement, what you don't want to have is a closer correlation where you have stocks and bonds going down together like what happened in 2022, which obviously is why this chart's cut off at 2021. So if you'd like to talk more, if you're not a client of mine and you'd like to talk more about what that looks like for you and options-based strategies and how that works within a portfolio, just reach out to me. Happy to chat a little bit more in depth about that. If you're a current client and you want to get more information because you are invested in it, and I know we've probably talked about it before, but if you'd like to hear more about it, happy to obviously chat about that with you during a review. So just reach out to me. But I appreciate you guys checking this out. For anybody that's coming across people that would be interested in having a conversation with me, just get them connected with me. Be happy to chat more in depth with them. But I appreciate you all taking the time to check me out here, and you guys have a happy Easter, and look forward to seeing you the next time.